Hey everyone, welcome back to Corporate Decoder. Today we are diving into a new report about Banc of California. It's got some interesting twists and turns, almost like a California freeway and about as predictable. Let's see if we can navigate through it. This filing reveals a bank that's walking a tightrope, showing profit growth, but also flashing warning signs like rising loan defaults. Is Banc of California turning things around or just delaying the inevitable? If you like getting the real story from these corporate filings, hit that subscribe button. Also, join our Discord community. The link is in the description below. Let's decode together. Alright, let's jump right into the financials for the first quarter of 2025. Loans are the bread and butter of a bank, the money they made from lending. In this report, we see interest earned on loans and leases hit 346 times on $1 million. They also made $37.9 million in interest from investment securities. That's the money they make from bonds and similar investments. Lastly, they also have their own money in other banks, and that earned them $22.7 million. Altogether, their total interest income clocks in at $406.7 million. Of course, to make money, they also have to spend money. That's in the form of interest expense, mostly what they paid on deposits, $140 and $5 million to be exact. And Knife Next biggest expense is from borrowings at $18.4 million and another $15.3 million from subordinated debt, which is a kind of riskier debt, and in total that comes out to $174,300 in total that comes out to $174 million and another $15.3 million. Add in $15.3 million in interest expense. So at the end of the day, their net interest income, what they earned minus what they paid out, sits at $232 per million. Now, this is where it gets a little tricky. Banks have to account for the possibility that not everyone pays back their loans. And it seems like Banc of California expects some more trouble, so they allocated $9.3 million in provision for credit losses. That leaves them with $223 million. Then we have other income and expenses, but at the end of the day, their net earnings, their profit after all expenses, came out to $53.6 million. It's a good number to hit, but let's compare it to others. Just for comparison, in the previous quarter, the net earnings were $56.9 million. And going even further back to the first quarter of 2024, they were only $30.9 million. Now, everyone always asks about earnings per share, how much money each share of stock technically earned. Basic earnings per share are at 0.26 cents. Diluted earnings per share, which account for other factors, are also 0.26. Here's another tricky part that you should know, and this part will give you a headache. Check this out. Unrealized net holding gains on securities were $38.5 million. That's how much they could make if they sold their investments, that is, but wait for it. That's not all gravy. They are expected to pay taxes of $11 million on that if they were to realize those gains. In summary, it's very important to know they can make more if they sold their investment, but it's not real earnings until you sell. Okay, next up is restricted cash. This is cash that the bank has to keep for various reasons. Think of it as money they can't really use. At the end of March, they had $9 Ols at the $4 Eve contracts and $118.6 million for the credit-linked notes. So what kind of investments does Banc of California hold? It appears a lot of municipal bonds. And remember how people see municipal bonds as safe? Well, it seems that at least on paper, the bank lost $244.15 under various market conditions. There were no sales of available for sale securities either this quarter or the same time last year. That means, at least for now, it's just an on-paper loss for bonds that they held to maturity, which means they intend to hold them forever and get paid the bonds rate over time. The value is still underwater compared to their price. In this case, the bank might be betting on the economy to make a turn, which in turn would justify the higher prices they paid for these investments. Loans and leases are down slightly from the last quarter. They are at $24.1 billion, down from $23.8 billion of last year. Here are some of the types of loans they hold. Real estate mortgage loans totaling $13 there. Real estate construction and land loans totaling about $2.9 billion. Commercial loans, which clocks in at $7.4 billion. And then a bit of consumer lending, about $393 million. Of course, there is also the risk that the borrowers don't pay the bank back. That is called the allowance for loan and lease losses, and it sits at $235 million. Deposits are always important. They have about $7.6 billion deposits and about $19.6 billion deposits outlets. See if there are any warning flags on loans. It seems like most people are paying their dues, but they do report how many people are between 30 and 89 days late, and they have FR $95.8 million in real estate mortgage loans, $7 million in real estate construction and land loans past due, 0 in real estate construction and land loans past due, $70.3 million in consumer loans past due, 0 in real estate construction and land loans past due, 7. 2.0 in real estate construction and land loans past due, 20 real estate construction. And to complete the picture, let's see the loans in dire straits. Over 90 days past due, we have EI 93.6, due Avant 0 in real estate mortgage loans, 6 million 0 in real estate construction, and land loans past due all 5 to $6 million in Timferman, Conorian all $6 million 0 Ireland, $6 million in consumer loans past due. Finally, let's take a look at where the bank spent its money. A whopping $86.4 million went to compensation, meaning salaries, bonuses, and such. Insurance and assessments such as FDIC fees were relatively small at $7.3 million, and $7.2 million to amortization of intangible assets, which amortizing or paying off the money made from goodwill brands. For a final glimpse, these items let them achieve 26 cents per share diluted. Lastly, for the final piece of the filing, there's one little interesting thing that comes up. On their balance sheet, they mention a deferred tax asset, or DTA. Banks get these if they overpaid their taxes in previous years. The Banc of California reports a DTA of $702.3 million. It can be considered a little aggressive to have a high amount of it, as it means the bank doesn't expect to make as much money in the future and therefore pay more taxes than it already did, so it can use these credits. So what's the story here? It seems like Banc of California is improving its earnings from the same time last year. They are repurchasing stock, improving key costs, and getting the business in shape after a tough acquisition. But there are still a few headwinds, such as certain loan defaults and some value lost on their holdings. Their income stability will be tested with the ever-changing rates. They're playing it a bit safer, at least for now, which is probably what their investors want, given the previous issues with PacWest. Their goal seems to be slow and steady growth with some interesting credit choices that could pay off handsomely or add more risks. What do you think about Banc of California after looking at the numbers? Let me know in the comments. If this deep dive was helpful, please like and subscribe. Be sure to join our Discord. It is linked in the description. Let's talk all about this and other filings there. I'll see you in the next one.